Hey, welcome back. With the stock more than doubling since a year ago and reaching new all-time highs over and over, let's see if there is potential in Amazon. I think everyone knows them. They offer a variety of products and services, from the e-commerce platform to video streaming, cloud services, pharma, gaming, and so on. They were able to develop into a very diversified company through a series of acquisitions and smart investments. Now that they focus on international expansion, the potential can be even more impressive. After a bunch of investments, they can make around 50 billion per year with potential to grow. They have the goal to optimize the free cash flow, which I think is something that you really want to see as an investor. For a roughly 2 trillion market cap, that's a ratio of around 40. The average has been in that 40 to 50 area so far, so nothing unusual. They reported a good start of the year with increases in sales, profit, and pretty much everything. Even at this size, they can still manage to deliver double-digit growth, which is impressive. A majority of the revenue comes from North America, so you can see the potential of an international expansion, which is something they focus on. They talk about efficiently managing dilution, but if you think about it, they have the advantage of a generally high valuation. Taking advantage of it to buy other companies for like 15-20 times the cash flow and integrate and optimize them can be very profitable. I think something like a 2-3% dilution per year, meaning 40 to 60 billion, can really fuel a lot of growth. But it's a matter of what they mean by efficient. 50 billion can buy entire industries. The thing is, if they don't dilute and invest enough, then the growth can be too slow, which would then probably affect the stock even more than the dilution. Even if they don't get that much publicity, Amazon is a company with a very rich history of acquisitions. They keep buying companies and adding them to AWS or Prime or Amazon Pay, or they make entirely new branches. Look at the MGM deal, for example. They got it to boost Prime and similar branches. The current assets cover the current liabilities by a good amount, but the total assets are well above the total liabilities, so they are in a great financial shape. This is very common with the blue chip tech stocks. The equity is a tenth of the market cap, but that's also not unusual for a tech company. Now, this is a perfect example of a business that excels in synergies. Thanks especially to Prime and things like AWS, they can integrate things together, and even the new stuff that they buy can get boosted instantly. With Prime, you get basically Netflix, Spotify, plus free delivery, games, deals, prescription discounts, and a variety of things. And another advantage is that unlike Netflix, for example, who's barely profitable, they have the money to develop and compete in these markets forever. By expanding into so many industries, they can offer an unbeatable package at a good price. Now, this is something that I said in the WBD analysis too. If they want to spend like a year of cash flows and secure a lifetime of content, they can buy Warner Bros. If they do that, they'd have enough IPs to even compete with Disney instead of having to pay as much as they did for Lord of the Rings. They can use it to develop into other kinds of media as well, so I think it would be a good move. If they want, they could use the high valuation to pay it with shares instead of cash, and you'd barely feel the dilution. There is potential from international expansion since they aren't that big in Europe, for example. But that might require them to go into another investment cycle, which the market often doesn't like. But for you as an investor, that should be very good news, because if you want to see them triple, quadruple, or whatever in a decade or two, that's probably how they do it. If they can take the model, adapt it, and apply it in other countries, the potential would be really incredible. I think the balance sheet should allow them to do that, especially if they also issue shares. Now, a risk and ultimately a barrier would come from regulators. They are often sued and have to pay pretty big fines, which can slow down a potential expansion. This is a, let's say, pending issue, as we can never know what will come next. And politics is probably one of the most unpredictable things out there. There is the extreme case where they would even get split, but I don't think that's very likely. They can be denied the expansion, however, and that can be a big issue. Look at Microsoft and Activision Blizzard. They waited over a year after the initial announcement to buy them, which can give the market enough time to prepare. Imagine if they waited for, let's say, 10 months and then it was denied. This kind of acquisition takes a lot of time and planning and resources even before announcing it. All of that would be wasted if it gets denied, and from the looks of it, the FTC, for example, is kind of against this type of deal lately. Now, despite a strong presence in the US, competition can still be a problem, especially internationally. We saw Temu, for example, rapidly eating a good chunk of the market share, and companies like Alibaba are also expanding. This would make Amazon's global expansion slower and much more expensive, especially if we get into a recession. This type of company is generally very sensitive to that, but on the bright side, rate cuts would stimulate the economy and would likely boost their performance. As for valuation, the issue is that we don't really know how much they can reliably make. In a negative scenario, let's assume they make around 35 billion. They can get there maybe if they get into some trouble or the competition heats up. Keep in mind that even this would be relatively high for Amazon. For a ratio of 25, which is generally high but pretty low for them, that's a market cap of 875 billion. By the way, one of the reasons why the ratios can be so high for them is that there is so much demand from funds and retail investors that it either falls a lot due to general panic or not too much because someone would buy and the supply and demand would balance. That's a price of 84.07, so more than a 50% loss. They were at such a price a year ago though, so it's not impossible. In a second scenario, let's say they keep making around 45 billion like they do now. For a ratio of 35, that's a market cap of 1.575 trillion, meaning a price of 151.32. That's roughly 20% below the current price, so we can see that the market is even more optimistic or it believes there is growth ahead. Now, in the future, if they continue to grow, let's say they get to 65 billion. For a ratio of 40, that's 2.6 trillion, meaning a price of 250. So pretty much a 30% profit in 2, 3, 4 years, which is not bad but also not the best. However, 65 billion is what Alphabet can do, and that's a $2 trillion company as well. I think this average of like 40 may be a bit too much. Maybe something like 30 or 35 would be more fair for Amazon. Sure, there is Microsoft, who's a $3 trillion company making the same as Google, but I don't think that's an example of a fair value. And the thing is, the difference between the three isn't justified. They are all very good businesses with high potential. If I get the chance to buy them at like 20 times the cash flow, then I'd probably do it. That would be a price of like 100 per share. Overall, Amazon is a very solid company with good financials and a very nice business model. They offer an unbeatable package, and the synergies they can generate have the potential to make any acquisition into a very profitable branch of the business. They aren't the cheapest, but for some portfolio stability with a great company, they should be fine. There is potential to grow, especially if they expand into other countries or keep expanding into other industries. If they keep growing at nice double-digit figures, the stock will likely follow. Out of the Magnificent 7, I'd say this is maybe my third favorite. As always, what I cover in my videos shouldn't be enough for you to make any investment decision, so please do your own research before investing in anything. If you want to see more videos like this one, please leave a like and even a comment to help me out, and make sure to subscribe. Thank you for watching, and I'll see you next time.